It's becoming increasingly clear that Canada and the U.S. could be on diverging paths when it comes to monetary policy. Most economists expect a rate cut by the Bank of Canada this summer, and it's unclear whether the Fed will be able to deliver one this year at all. Let's bring in Hank Cunningham, fixed income strategist at Odlum Brown. He joins us for his insight. Hank, there's always a risk to looking at what the market is pricing in, because we started January expecting a very different picture. But how do you think about where we're positioned, what we're priced in? Does it feel realistic that the Bank of Canada will cut first?
I believe they will. They won't be the only central bank, Amber. I believe that the ECB will also lead the Fed here, I think, for domestic reasons. The Bank of Canada doesn't have the same dual mandate that the Fed has, which is to make sure that prices are stable and employment is good. The Canadian Bank of Canada has a different mandate just to promote a healthy economy. So I think, given the weakness lately in consumer spending numbers, and consumer confidence is shrinking, and the GDP is definitely on the wane, I think we're going to see the bank move before the Fed does.
And as a fixed income strategist, how do you think about what that means for, the Canadian fixed income environment landscape versus the U.S.?
I think it means that we're going to get steeper. Well, we'll get a positive yield curve eventually, Amber. I usually, the vernacular phrase is a bear steepener, which means that I think short-term rates up to like 2 to 4 years can decline significantly, while longer-term rates will stay where they are, actually rise, because I think long-term bonds are still poorly priced and investors aren't getting compensated properly for the term premium that they should be receiving.
When you look at, with that in mind, where you're finding opportunities across that curve, what years are you focused on? Do you have a preference, government versus corporates?
At the moment, we prefer the 2 to 4 year term in government bonds. The corporate spreads are at historic lows, and there's very little value left in the corporate market compared to governments. There are a lot of good provincial issues that offer attractive yields compared to Canada's and compared to corporate. So that's where we're featuring right now. And you get really excellent liquidity when you invest in both federal and provincial bonds for the occasion when you want to extend into corporates, rather, at some point in time when their yield spreads are more attractive. But right now we like the governments in the 2 to 4 year term. We also like the after-tax bonds. I think we mentioned it the last time I was on, Amber, about the discount bonds that were created when we had 0% interest rates. So we still are very much drawn towards corporates and provincials, where their discounts provide really good after-tax yields, especially compared to GICs. And also they have a good rate of return potential, offering steep discounts, and they will provide a really good rate of return when the yield curve begins to steepen.
Let's talk about the fixed income mindset of investors. And I mean, we've had a lot to catch up with in the last couple of years, right? Going from 0% to 5% yields that are now available. And we're kind of just talking about it like this is regular. But it is kind of irregular. And I wonder if investors' mindset about fixed income has shifted as rapidly as the yields have.
I don't know if I can answer that, Amber, but I do know that people all of a sudden wake up and realize they can get 5% in a 1 year US T-bill, or close to that in Canada, and they realize that there's something else I can do with my money besides leave it in the bank earning zero. So sure, it's people are starting to shop for yield now. And of course, that begs the question, when people shop for yield, they sometimes reach too far and go into securities that are a little maybe too risky for the extra yield you get. So I think there's been a bit of a shift. Yeah, I think you're right about that. And people getting used to actually getting something in return for their money.